conference call hosted by Axis Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Mr. Kashyap Pujara from Axis Capital. Thank you, and over to you, Kashyap.
Thanks. Hi, everyone. Good morning to all of you, and thank you so much for standing by. It's a great pleasure to have with us the entire management of Tube Investments. For the first time, I would say that all the relevant top members of Tube Investments are present on this call. And from the management side, we have Mr. Vellayan Subbiah, who is the Managing Director. We have Mr. Mukesh Ahuja, who heads the Tube business. We have Mr. Srinivasan, who heads the metal forming business. We have Mr. Paul, who heads the cycle business. And we have Mr. Mahendra Kumar, who is the CFO. And we also have Mr. Ramanujam and Ramshankar, who are part of the finance team. So over to you, Mr. Vellayan, and many congrats for a decent set of numbers in an otherwise challenging environment in Q4. Over to you, sir.
Thanks, Kashyap, and good morning, everybody. Basically, I just want to give you a quick run through on Q4 and end of year performance, and then obviously I'll be happy to turn it over for Q&A. Basically, as you know, we had declared an interim dividend of 350 per share in February 2020, and that was paid to the shareholders in March. Consequent to the COVID pandemic and lockdown, the operations, across various locations in the country had to be shut down from March 23rd onwards, and that has continued in the month of April. With the easing of lockdown and curfew, the company from May 2020 has resumed operations in a partial manner across pretty much all of its locations, with the exception of 2. So, highlights for the fourth quarter and for the year. Basically, revenue for the fourth quarter was 935 crores compared to 1224 crores in Q4 of last year. And revenue for the year was 4,276 crores, which is lower by 19% over last year. The PBT before exceptional items, and we'll talk about exceptional items in a bit, was 108 crores, which is a growth of 26% over Q4 last year. And PBT for the year was at 421 crores, which is a growth of 13% over last year. The ROCE is at 23% compared to 21%, and free cash flow is at 320 crores, which is 97% of that. The strong free cash flow has resulted in our net debt reduction of 342 crores. So from 491 crores in debt, we are down to 149 crores at the end of March. So I definitely say that the free cash flow and kind of strengthening our balance sheet was fairly a timely move for us, given kind of what we're faced with in the current environment. We can talk about that more future-looking stuff as we go ahead. Just to let you know on exceptional items, this last quarter and this happened kind of before. We kind of negotiated it and kind of happened, so we were already doing it without COVID. The company implemented a voluntary retirement scheme, and that cost us 22 crores. And that same amount is considered an exceptional item, in PBT. So that is the exceptional item for the quarter, the 22 crores VRS scheme, voluntary retirement scheme. I'll just go through each of the businesses quickly. For engineering, revenue for the quarter was at 545 compared with 659 in the corresponding quarter previous year. PBIT was at 75 crores for the quarter as against 65 in the corresponding quarter, which is a growth of 16%. Revenue for the full year for engineering, 2,258 crores compared to 2,896, and PBT at 264 crores as against 254. In the previous year, it's a growth of 4%. And ROC for the division improved to 41% as against 37% in the previous year. So Mukesh is here, who heads that division, and I would definitely say congratulations to him and his team for pulling off an incredible story in terms of efficiency, working capital improvement, and profit enhancement in a very tough market. The second business is cycles and accessories. The division registered revenues of 129 crores compared to 250 crores in the previous corresponding quarter previous year. There's a huge drop, and let me just explain that drop. It's predominantly because of our exit from the institutional sales part of the business, which we have chosen not to participate in the financial year that just got done. PBIT for the business, though, was 6 crores compared to the loss before interest and tax of 7 crores in the corresponding quarter of the previous year. That, and I'll give you the annual results as well. Revenue for the full year was 781 crores versus 1238. Again, the drop is predominantly due to the exit from the institutional sales business. And PBIT improved to 26 crores as against 11 crores in the previous year. So though we've had a drop in revenue, significant drop in revenue, our PBIT actually has gone up. The ROC for the division has improved to 17% compared to 6% in the previous year. Now, that improvement in PBIT I will fully attribute to the strong work that Kalyan and his team have done in terms of significantly turning around Cycles business. I would say it's been a full-scale turnaround, increases in operational efficiency, significant work on the ground in terms of improving the sales infrastructure, improving our relationships with the distribution channels, modifying kind of the structure of distribution we use in itself, and also looking at significant cost reductions where necessary, especially in the areas of sourcing and logistics and the warehouse infrastructure. They've totally rehauled the warehouse infrastructure across the country in much leaner format. And all of those actions combined have resulted in this significant profit enhancement. If it were not for COVID, we were fairly convinced that we would deliver a much stronger year this year than last year. But we're still continuing on all of the activities that will strengthen the Cycles business as well. In terms of metal form products, revenue for the quarter was at 301 compared to 358 in the corresponding this year. PBIT for the quarter was 16 crores as against 31 crores in the corresponding quarter last year. And revenue for the full year was at 1399 as against 1360 in the previous year. PBIT for the year remained flat at 123. And ROC for the division was at 26% versus 27% in the previous year. Consolidated results on an annual basis, revenue was at 4750 versus 5773, and the PAT was 313 as against 251 crores in the previous year. Shanti Gears basically had a flat revenue year overall at 242 crores, and PBT there was at 33 crores versus 42 crores in the previous year. So that's a quick overview on our previous quarter and year, and Kashyap and team will be happy to kind of the team and I will be happy to kind of take any questions that the audience has today. Thanks again for everybody for joining us, and we'll be happy to take questions now.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one. First question is from the line of Shyam Sundar Sriram from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Good morning. Thanks much for the opportunity, and many congratulations on the continuing performance improvement that we have seen during the year as well as every quarter on quarter, sir. Congratulations on that front. My question is firstly on the revenue side. From this quarter perspective, on the metal forming division, we have seen a decline on a quarter on quarter basis, whereas engineering has done better there sequentially, while a sequential may not be a good parameter. But what has impacted metal forming during this quarter? Even the EBIT margin for metal forming has come off during the quarter. Was it because anything in the aftermarket side or any color you can give on that?
Yeah. Aftermarket actually has been stronger, but let me ask K.R. Srinivasan, who joined us on the call, to give us kind of quick perspective. He runs that business.
Yeah, Srinivasan here. This quarter, the decline was in the OEM business mainly. both two-wheelers and four-wheelers, the overall auto market slowdown really impacted the business. That is the main reason. Otherwise, strong performances were there in aftermarket and the non-auto sector parts of the metal forming business.
Okay. Understood.
Yeah.
So non-auto, when you mean the railways,
railways and industrial chains. So those kind of product segments we have done there.
Okay. And sir, and why, whereas, I mean, I'm just trying to understand, engineering division has improved sequentially in terms of revenue momentum, whereas, I mean, there's a good chunk of auto OE dependence, whereas metal forming has been the other way. So just trying to understand this gap between the two performances.
There are different OEs and there are different segments in auto.
Right.
So, for example, one is much more dependent on two-wheelers and CVs. One is MFPD, for example, has a pretty strong dependence in one of its businesses on four-wheeler passenger cars. So it's basically due to sectoral differences.
Okay. The door metal for the door forming segment.
Exactly, right? So, but on the other, like tubes, the tubular front forks are much more dependent on two-wheelers, right?
Okay. Understood. And from an outlook perspective on exports and aftermarket auto chains and industrial chains as well as the railway business, if you can give some color on that.
Yeah. So I think, first off, obviously, kind of given where we're at, and we can have a broader discussion on this, we just do not feel like we are in any position to give any guidance or any forward-looking commentary at this stage. And honestly, I don't think anybody has the answers. But what I would say is that kind of, KRS, you can comment more on it. We are kind of encouraged by what we've seen, but it's just, honestly, Shyam, it's too early to comment on anything, right? I mean, so do we think that aftermarket will pick up? I mean, nobody knows. There's been kind of so much, we don't know whether the initial buying is just kind of pent-up demand. It's just kind of too early to speculate on anything, right? Even exports, right? I mean, some orders have started coming in, but can we make any judgment now on kind of what the year is going to look like? I definitely say that answer to that question is no, right? So, broadly to give kind of the entire audience a perspective on that, I would say that we just don't feel very comfortable at this stage to comment on, any particular market or how the year in particular is going to shape up.
Understood, sir. Understood. Just one question, if I may speak, on the margin front, sir. From a gross margin perspective, we have continuously been improving with alternate suppliers coming into foray and the mix also getting better. So, going forward, are we seeing further benefits that may flow through here, or is it largely done for now? And these mix a major reason for the gross margin improvement, if you see for this quarter, for example, compared to all the three prior quarters. What is the role of mix in the gross margin improvement? And just one question along with that, we have undertaken a VRS exercise. So do we expect employee costs to now start softening from here on going forward? Any quantification if you can give on that front? Thank you.
Okay. Shyam, you asked so many questions. I didn't take proper notes, man. So to answer your question on VRS, I think the answer there is fairly simple. The maths you can use is, if you incur a cost of X in VRS, we usually determine a payback of about, of approximately 4 years, which means that the cost will decrease by X by 4 on an annual basis. Okay, that's the first thing. The second question you asked is kind of the costs or the margin improvement, is that margin improvement story done? And there, I think we've alluded to it on previous calls as well. We definitely do not think the margin improvement story is done, right? Because we do see opportunity for margin improvement. Like I said, right, whichever area you take, right, whether it's quality, whether it's mix, whether it's sourcing, whether it's logistics and transportation, we continue to see. We do not believe that we're done on that story at all. I would say that, if anything, we're about halfway there on that story. Again, I don't want to give guidance on timing because honestly, guys, it's very difficult, based on kind of, on fixed costs and ratios to predict what this year is going to look like. But my point is that the margin improvement story is not done. And overall, if we take kind of where we are on that journey, I would say we're about 50% of the way there.
Understood, sir. And all the supply chain issues are now resolved, sir, at least from our perspective, our vendors, from a steel procurement or imports perspective, is that all now resolved?
No. I don't. Are you saying post-COVID, is it all solved?
Yes, sir. Now.
No. I mean, I definitely would say that is not the case. There will continue to be issues. But it's not the case that, everything has kind of already been addressed and, we're back to 100% normal. That's definitely not the case in the market right now.
Oh. Understood. Thank you very much, sir. I'll come back.
Thank you.
Thank you. A reminder to participants, anyone who wishes to ask a question, let's press star and one. The next question is from the line of Sushmit Patodia from Motilal Oswal Asset Management. Please go ahead.
Hi, Vilas.
How are you?
Hi, team. I'm good. How are you guys?
Good.
We're talking to the two hotbeds of India, Chennai and Bombay. So, just a couple of longer-term questions. One is, this whole the future leg of growth that you had illustrated to us recently. How do we now think about this? And I'm sure, unfortunately, the project that you had nearly commissioned would have gone into a little bit of a pause as well. So if you could just, has there been any change in thinking there, or have opportunities actually increased?
Yeah. So I think we should definitely, so to give the broader audience a perspective also, I would say that, this year, definitely the way I look at it is kind of, just even from a personal time investment perspective, I continue to shift more and more of my time to what we are articulating as TI2 and TI3. I think you all are familiar with that nomenclature now. TI1 is the existing businesses and growth in those businesses. And we have a very able team basically driving that between KKP, Mukesh and KRS. And TI2 we'd articulated as kind of, growth, from in a more venture capital format where we would start 10 new businesses. And we think, that, 4 or 5 of those can become significant businesses for TI over time. And, 6 of them will likely fail. And TI3, which is basically, acquisitions and, potentially we've always said we want to do full value acquisitions, but will also help us diversify away from the auto sector, and kind of, allow us to get new areas of growth for the company. And so, Sushmit, I would say that program, if anything, has been reinforced by this environment.
Yeah.
Right. That we want to increase our focus on both TI2 and TI3. And we're continuing to kind of drive a lot of our energy towards those two. As a matter of fact, I definitely think kind of on that third side, which is TI3 and the acquisitions, the market is offering up a lot of opportunities right now, and will likely do so more as the year progresses. So we continue to be very excited by both of those sides. And I think the good news for us is that we pretty much got debt. We had said debt less than net working capital, and the good thing is that we're significantly less than net working capital. And I think that will hold us in good stead in an environment like this where we go into it without too much leverage. So even if we need to take some leverage for an acquisition, we would do it with a higher degree of comfort. Obviously, we're going to be cautious in this environment, and we continue to kind of see how things play out. But I just feel that it's better that we're going into it with a stronger balance sheet. So in that way, we're kind of blessed by some of the actions we've taken in the past 2 years. But definitely TI2 and TI3 as a strategy are very intact. And, we really plan on pushing more on those in this environment. Our TI optical, unfortunately, basically, we were hoping to get that, up and going this quarter.
Yeah.
But the good news is that now all the equipment is in. We still actually have some of the Korean kind of folks where we've got the equipment from kind of on the ground there testing it out. And I feel fairly confident that if it's not this quarter, we'll definitely get it up, in the month of July. And, we've already started testing, individual pieces of equipment in that plant. So the plant's up and running. But, by the time we get to full saleable production, it could be, in a sense, like, we have to just see how the environment goes. Because right now we also have issues, moving people across the state border from Chennai because there are facilities in Andhra Pradesh.
Andhra Pradesh, yeah.
So we have challenges moving people across state borders because, like you said, people don't seem to want people from Tamil Nadu or Maharashtra.
Yeah.
So we'll see how that evolves, but we continue to remain bullish about kind of, growth for those businesses. So TI2 and TI3, that strategy is very much intact.
Okay. And my second question is just on trade receivables. Any dangers that you think there is, or the 524 crores is pretty safe, nothing to be worried about?
Mahendra, do you want to talk to that?
Yeah, sure. So we did that assessment as soon as we started seeing this COVID situation unfold.
Yes, sir.
At all there was any risk, there was a risk only on the receivables from the dealers. But there again,
Correct.
There is no threat or no big surprise waiting for us in that particular area. Everything seems to be pretty safe as of now.
Sir, I couldn't hear you at the end. I'm sorry.
Yeah, Mahendra, you have to speak up. I don't think you're very clear.
No.
Is it better now?
Yes, sir. Yes, sir.
So we did that assessment as soon as the COVID situation started unfolding. We were initially having some concerns about the receivables from the dealer community, both in cycles business and also aftermarket business. But after our assessment, we concluded that there is no big threat waiting for us there. It's all safe.
Okay. All right. Thank you, and best of luck for the future.
Thanks.
Stay safe, team. Yeah. Thank you.
Thank you. The next question is from the line of Abhishek Ghosh from DSP Mutual Fund. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. Hi. So just a couple of things. About a year and a half back, 2 years back, you were looking at more like, so the original guidance was 15% plus revenue growth and a PBT margin of 10%. That was the two elements of, P&L that we were looking at. Now, obviously, because of the external environment, revenue, growth was obviously from the entire sector was kind of missing, and we also, were a part of that. But despite that, you've been able to maintain that, or you've been able to achieve that 9.8% PBT margin for the entire year.
Mm-hmm.
So there is an element of negative operating leverage which is sitting here, even despite which you could get to that 10% PBT margin. So I'm saying whenever things come back, you think your resources, capacity, everything is in place, and where can this look like? Not to get into numbers, but just your broad thoughts there.
Yeah. No, you're right. Definitely we see that. I think everybody, for the last, I don't know how many quarters we've all been saying, whenever things come back. Right? So, I think part of the problem is we don't know, Abhishek, when things are going to come back. Right?
Yeah.
In theory, what you're saying is correct, right? In the sense that that's also our belief, right? Which is like, if you've got that, we're not obviously going to increase kind of, a whole fixed cost structure once it comes back. And as a matter of fact, in this environment, we're only thinking of how we get leaner, right? And kind of, so that's kind of, that's basically, what you're saying definitely is something that we believe. That's why I've always said that, I don't think the margin improvement story is over. And it kind of goes back to the earlier question where, I think we're probably halfway there, right? On the margin improvement side, right? And so I think that's continuously, basically what you have to think of it is that this is becoming a mindset of the company. Right? I always say that companies kind of operate on mindsets, right? So all leading companies in the world, if you create that mindset that, kind of, hey, there is more opportunity, leadership in the company will figure out ways of getting it, right? And I think that's what kind of Mukesh and KKP and KRS have demonstrated, right? So I think that, if you take what Paul's done with the cycles business, right? Everybody was saying, hey, listen, kind of, not much there in terms of margins. But just in 1 year, despite the fact that we've kind of exited institutional sales and dropped, almost like 33% in terms of overall revenue, we've over doubled the profit, right? We've over doubled the PBIT. And the team, is doing more and more kind of exciting and innovating stuff. So I think that's the way you've got to look at it, which is, that is what you're saying is definitely in line with our belief. We think that there's more headroom there. We'll continue to kind of push on any driver that can help us improve margins over time.
Sure. Also, we've raised this thing for the some NCD raising. So is there something you just want to create a war chest or?
Yes, it's a standard board approval that we always get, saying that in case we need to raise, we need to get a blanket approval. There's nothing. It's just like you're saying, to create a war chest in case we need to draw down. We don't want at that stage to have to go and get an approval, so we're just getting it.
Okay. And so all the acquisitions and other things that you were looking at from last 6 months, 1 year, they must have only got sweeter now, right, with the current crisis?
Yeah, I think that's similar to the question Sushmita asked. Definitely, we're seeing much, much more opportunity coming up on that side. So we continue to kind of look at a couple of transactions that we were looking in the past, and so so the thing is that it's almost good that we've not been in a hurry.
Sure.
And but I 100% agree with you, which is they're just getting more attractive now.
Okay. And just one last question from my side. Now, in this environment, what we are seeing is the industries or the companies which are not that well managed, sitting on high working capital receivables, are under a lot of stress. You think that can allow you to gain some amount of market share in some of the, not maybe in cycles, but in the other two divisions? You think the industry structure is such that some of the weaker players can just get out and help you gain market share? Is that something that you see, or is it too early to comment there?
Mukesh, do you want to answer that for engineering, and then KRS, do you have a perspective as well? Mukesh first, perhaps?
Yeah. From engineering side, maybe let's say we see definitely maybe that is going forward. It may be opportunity, maybe let's say, because we see our competition maybe let's say sitting relatively on the higher receivables and even maybe let's say and the debt levels. And how maybe let's say they'll be able to manage this, and whether that is going to give a headroom for maybe gaining shares. Definitely we see there will be opportunity available going forward on that particular account.
KRS, do you have a perspective?
Yes. Yeah, both in two-wheeler and four-wheeler, where we are directly servicing the OEMs, we definitely see some opportunity for improving this year in the current perspective.
Yeah. KRS, you have to speak up a bit.
Yeah.
Yeah. Okay, sir. Thank you so much for answering my questions to the team, and all the best. Thank you.
Thank you. Thanks so much.
Thank you. Thank you. The next question is from the line of Jeetu Punjabi from EN Investments. Please go ahead.
Yeah, hi, Brilliant. Thanks for this. Two questions here. One, as you recalibrate what's the other side or what's the new normal of post-COVID world, are there any significant structural changes to your business or to the end demand markets or whatever, where you think that some part of it is never going to come back and it's dead, and some part of it is a brand new opportunity that we need to focus on? So I'd love to hear your thoughts on how, if there has been thinking on this, whether there is structural changes happening at the other side of this 6 or 12 months from now.
Yeah, so I think that's a great question. The broad perspective I have at this stage, and we've talked about it kind of a bit internally, I think the broad perspective we have at this stage is that, first off, we think it's too early to tell, right? Because whichever, for example, earlier on we were talking and we said, hey, listen, we have a high interest in electric because we think electrification is going to come sooner than some of the folks expected in India, right? Now there's all of this question saying, hey, listen, will electrification get slowed down or accelerated by COVID, right? And honestly, the jury is out. And we don't think kind of, we are gonna, we continue to believe that, hey, it's coming, right? Now, whether it's getting accelerated or slowed down, we don't have a good sense yet, right? I mean, in theory, there just seem to be so many macro factors, right? Kind of, oil prices crashing at the same time, all kinds of stuff happening, right? So I think that, what we notice when we look at our set of businesses is we broadly said this, right? The thing we've had commentary for a while is that, hey, listen, we think electrification is coming. Do we still believe that? 100%. We still believe that, right? The second commentary that and guidance we've been giving for a while is that we want to reduce our dependence on the auto sector. So we want to start moving away from the auto sector with our new businesses and with TI2 and TI3. Do we still believe that? Yes, we still believe that that's the case, right? We have to reduce our dependence on the sector, and we need to move into, kind of other sectors in the engineering and industrial domain. So broadly, I would say that kind of our overall tenets we feel still hold good as far as manufacturing is concerned. And it's things that were there in a pre-COVID world. The big question is how accelerated are they going to get in a post-COVID world? And I think we don't have at least we don't feel like we are the experts who have the answer to that. Do we feel like that fundamental direction is changing? No. Right? Whether it's electrification or whether it's kind of diversification away from auto, because we see kind of, we see we just see that these are just prudent things to do for us as a company, and we believe that we'll continue to do them.
Okay. Excellent. Second one is, we're obviously sitting in very uncertain times as far as knowing what's the path to normalization. Mm-hmm. But having said that, if you kind of look out, whether it's 6 months or 9 months, do you have, and I'd love your best guesstimate on this, do you have a timeline of saying this is when we think we'll get back to 80% of normal, right? Or what we were doing. So in the sense, what's the curve going to look like, and how? The question is also if you assume that by December, I'm just saying a date that you're going to be 80% of normal, then you work towards it and you make sure that you're there. So I'm just saying, what is your operating assumption? How do you guess this whole thing's going to play out?
See, honestly, I think I've been asked this question several times before, and I've always said I'm a huge believer in the coin flip, because it's the most accurate predictive mechanism at this stage in time, right? And I still believe that, right? I mean, what you have to look at, and so honestly, I'm not trying to avoid the question, but, the way we look at it internally is like we don't know when that is, right? Do we have a perspective? Do we try and form it, for planning reasons, all of that? Maybe, but honestly, I don't think we have a good answer, right? I mean, everybody seems to be, kind of, cottoning around this idea that, by December we should be at 75 to 80%. But I don't think kind of, it's honestly, there's so many unknowns in this, right? I mean, right. Who knows, how long this thing is going to continue in India? I mean, none of us have answers, right? So I think in that environment, all we can do is just kind of take a look at it month by month, right? And, so it's not like there's a trajectory towards 80%, right? Because there's nothing that has to be done, right? If we're going to be at 80% in December, there's nothing that has to be done, right? In the sense, the question is, as a group, we take a longer term perspective on the people side. So are we going to make any kind of, huge, this thing, we don't feel like that is warranted yet, right? Yeah. But all I'm saying is that, though it might be the wrong thing to say, I do not believe that it's an environment where we can predict and act on that prediction, because I do not believe that it is predictable.
Oh, fair point. And just a quick follow on that. What do you think, and you can see this now, what do you think will be the two most difficult challenges in the path to normalization?
Right. So definitely what we're seeing right now is this issue of just, there are all kinds of problems in kind of getting the supply chain normalized. And by supply chain, I don't mean just kind of raw materials, I mean for labor, everything, right? Every component component of supply, whether it's raw material. So I think the guys who do the best planning on that, right? Saying, hey, listen, for example, also it has impact on cost, because the logistics costs get whacked, because you're always doing all of these exceptional things to kind of get, what you need into the plant, what you need to the customer. Everything is just is going a bit out of whack right now, right? So I think having the best mechanisms, right, and that's where I think some of the Japanese production system principles are very good in helping deal with some of this, because you tend to be much leaner by adopting those principles. And that's again, the Cycles guys have done some great work on that front. So I just think that all we can do is that whole area is definitely going to be one area. And the second, which is I don't know if you're asking more broader jnana for us in specific, but the broader issue is, the demand side, right, which is just nobody seems to have the answers to right now, right? Which is,
Correct.
Nobody has the answers to that. And we're all looking at indicators that we've never looked before to say oh, this is good news, this is bad news, right? But honestly, it's like I'm saying, there's almost that's where I told you, I think coin flip is as accurate.
Absolutely. So thanks so much, Julian. All the best, and good luck with the journey ahead.
Thank you.
Thank you. The next question is from the line of Kashyap Pujara from Axis Capital. Please go ahead.
Yeah, hi, Mr. Vellayan. I just wanted to ask a couple of questions which investors have posted. So the first is regarding our export strategy. Just wanted to check with you that is it possible that in a year like this, where domestic demand is any which way a difficult thing to predict and act on, but is it possible to scale up our exports, because that was mainly not towards capturing, growth, but it was mainly about capturing market share, because we were more competitive than others who were supplying to the same, customers. So can exports be a great driver this year, which can be explored by us?
Yeah, so definitely we have a strong focus on it. I'm going to let Mukesh talk specifically from the engineering perspective and tell us what he's been thinking of. I don't know if we have Paul on the line, but if Paul's there, perhaps it's early stages for him. But he, from the Cycles business as well, he's begun to start thinking about that. So I'll turn it over to first Mukesh, and then perhaps if Paul can chip in as well.
Regarding this engineering side, maybe our focus, let's say on exports, maybe before even COVID also, let's say that was our focus area to grow our business going forward. But let's say this COVID scenario brings another opportunity, let's say entire globe has started thinking for alternate supply chain solutions also, because dependency on the one country and is going to be a challenge. So how the alternates for the various supply chains can be done, where maybe let's say as a country as well as a company, I think we have a strong chance maybe let's say to participate that. We have already started work in that direction. Maybe we are in touch with our key customers, as well as we are exploring the new customer base where we were not present in the past. And there is fair amount of maybe work is going in that direction, and maybe we are confident we'll be able to crack some new accounts, and our strategy of earlier participating growth will get accelerated going forward in current scenario.
Sure, thanks.
Thank you.
Yeah, so one more question for you, Mr. Vellayan, would be why you mentioned twice on the call that we are 50% done as far as costs, and we still have a long way ahead. But what investors would like to understand is if you can break down the granularity as to which are the areas where you are comfortable that the cost levers have been pulled, and which are the areas where you still feel cost levers are yet pending to be scaled up. So if you can just give that, it would be helpful, because investors can then focus on some of those KPIs.
Sure. So like we said, in terms of the quality journey, we said it's a 5-year journey and we're 2 years into it. So I believe that, if you just linearly extrapolate, that's about 40% of the way there. But perhaps you can look at it as 50% done, 50% to go. So that's in terms of quality. What are the metrics that kind of drive from it? One is definitely kind of what are our reject rates, internal reject rates I'm talking about. And therefore, what will we be able to do with our internal reject rates over time? So I believe that, we're halfway there, and there's at least that much to be gotten, over the next couple of years. The second big lever, is, just on the sourcing front itself, right? Which is basically we think that we've taken some actions on what we can do on the sourcing front, but there's still a lot more we can do there. In a couple of areas, we've got very strong sourcing teams now, and they have started looking at kind of just how we begin to play this market. Now, obviously, again, that's going to be a bit structurally dependent, something that, we have to see what the government does, with regards to China. We need to understand how some of that's going to play out. But we definitely continue to see that as a opportunity that has significant legs over time. And then, I would say in terms of overall, when you look at other costs such as logistics costs and all of the supporting supply chain costs, there I'd say that, maybe we're a bit above 50% done, but there's still headroom that we continue to see. And then on the efficiency side, right? I mean, there also I think what COVID's going to do is force everybody to look at, what we start doing on the manpower and the efficiency side. That's what basically started triggering that first VRS that we did. But definitely we see more opportunity on that front as well. So I would say that those areas, definitely there is more leverage to be had, and we continue to see that we will be able to get that leverage over time.
Sure. Thanks. Asad, you can proceed to the next question in the queue.
Sure. Thank you. The next question is from the line of Ashutosh Tiwari from Equirus. Please go ahead.
Yeah, hello, sir. Congrats on very good set of numbers considering the environment. So firstly, last time we talked about that out of almost like 200 crore capex plan that we have for FY20, almost 140 crores was to be spent on new products. So is that same number that we achieved for the year, and also the plan going ahead for FY21 on the new product capex? Is there any change over there?
Mahendra, do you want to kind of chip in on this?
Yeah. So as of now, yes, the plan to spend 2 crores this year is still intact, but depending upon the situation.
Mahendra, you have to speak a bit louder and into the phone.
Is it better now?
Sure.
Yeah.
Yeah. So coming to the capex in the current year, the plan to spend about 200 crores is still intact. More or less, I think that will be spent, but there could be some difference here and there depending upon how the situation develops going forward.
Okay, and out of that, what part would be on the new product development?
A major chunk of it would be on the new product development only, because our regular maintenance capex is not much. It will be hardly 30-40 crores every year. A major chunk of that will be towards new products and new businesses.
Okay. And secondly, last time we talked about that we're developing a new product for export market related to some tubular product basically. So any update on that? How is the progress over there, and in what time frame we can expect that to commercialize and come into production?
Talking about the tubular products, the engineering?
Yeah. You talked about last time.
That mill has been ordered. Mukesh, you want to talk about the timeline really quickly?
Yeah. Let's say we started that journey this year and capex maybe whatever Mahendra shared, that let's say that is one of the big capex we are investing it for the capability building as well as new product development, which segments we are not present in today. As far as capex is concerned, it is going as per timelines, and we expect that to be completed by Q4 of this year. And going forward, which will give us a capability in the engineering sector to participate in the larger export market, as well as whatever BS4 to BS6 changes happened in the country, as well as the electrification drive continues. So that is going to give us some further maybe new product avenues to participate. So it is going as per timelines, and we will complete whatever internal targets we have actually on that.
So sir, on this product, are we in the stage still in the development, or are we also talking to customers on the same time?
leveraging our maybe current resources, we are already supplying this product in a very, very small quantities to various customers, so that before the full money and full CapEx is spent, we have a relevant experience for this product category. So in a small manner, maybe let's say in the various countries, we have already given samples, and maybe let's say it is at approval stage, so that maybe by the time the full CapEx gets commissioned, we are fully ready to participate in the market at this stage.
Okay. Thanks for that. And also, engineering division has done well on a quarter-on-quarter basis in Q4 versus Q3. Is it because we got that Activa front supply would have started from December? Is that the major reason why engineering has done well relatively?
Yes, you are rightly pointed out. This is one of the reasons for Q4 we are doing well. Maybe let's say the scooter which Activa TFF has started doing that, and we are fully participating in that, given our large market share. That is also one of the reasons, apart from many other reasons for doing better.
Okay. And sir,
I'm sorry to interrupt. Can you come back in queue for follow-up? The next question is from Lakshmi Narayan from ICICI Mutual Fund.
Yeah, I have two questions. Can you hear me?
It's not very clear. It seems to be an echo.
Is it better now?
Yeah.
First is that you had mentioned a couple of initiatives you have taken which has been successful. And if you can just go back to the last 1 year and see which are the two or three initiatives that did not do well as per your expectations, and what has been the institutional learning for that. That is my first question. Second is that if you can just give some information regarding Shanti Gears, because we don't get much details about that entity. What is the plan for that? How they are looking into the future? If you can actually give these two information, it would be nice.
So just to understand, your first question is what initiatives did not go well, or what growth?
Yeah, for example, you talked about cycles where there has been a change in institutional, reduction in institutional, which has actually resulted in almost doubling of the PBIT, right? Similarly, there have been some initiatives that have been successful. I just want to know what are the initiatives which did not pan out in the way in which you wanted to go ahead.
So I definitely say there are two areas, where we did not get from a growth perspective, where we had kind of more, the areas that continue to remain bullish on, but we did not get the growth we expected, was basically on, one was our TMT bar business, because basically that whole infrastructure segment was down significantly last year. And the second was our truck body business, where we thought we would kind of scale more effectively. The big challenge we had in truck body is that we found that most body manufacturers are effectively not paying GST, and as a result, kind of, our truck bodies end up being more expensive because we actually end up paying the tax versus the others that do not. And so one of the things we've done as a result of that is kind of change the focus on that business now to larger fleets and to how we can cater the largest fleets, because the larger fleets are okay with the GST because they can get the GST back as well, right? So those are both areas that I would definitely say that, in terms of learning, the significant things that we've learned from those businesses. And what are the institutional learnings? I think kind of it's basically to slow down the burn in businesses like that, right? Which is what we talked about, this venture capital approach. Slow down the burn so that we ensure we don't burn too much in so that's one thing that we have to basically look at. So I think that would be kind of the two areas that, kind of definitely we saw some institutional learnings. Your second question, sorry, I forget was?
This is on the Shanti Gears in terms of, yeah.
I know. I've always kind of said, Shanti Gears is good to get on from Shanti on their calls. But
I think they don't have a conference call format like much we do.
We call the management and request a call with them. I mean,
okay, fine, we'll do that.
Broadly on Shanti, the first half started off very well. and then we saw kind of a certain amount of sluggishness come into the second half. That was more related to kind of, part related to market conditions even before COVID. What we're doing there is kind of we're doing a fairly aggressive kind of rethink of the business in terms of, looking at what we feel the growth areas in that business can be. And I do think that there are significant growth areas. We think that that is one of the businesses that can benefit from this, China shift post-COVID, because a lot of this also happens in China today. A lot of the kind of gear and gearbox manufacturing that Shanti does. So what we're doing there is we're going to spend the next 3 months basically, and we've already started the initiative, but it'll take another couple of months at least to basically start fleshing out a more strong, revamped, kind of growth plan for that business. And so we probably have better answers for you at the end of that. But I would still say that we're kind of very bullish on the potential for that business. I would just say it's not delivered kind of yet, and we think that we have to kind of do a bit of a rethink in terms of how we drive growth there.
Okay, thank you so much.
Thank you.
Thank you. Next question is from the line of Srimant Odia from Unified Capital.
Good morning, and congrats on a good set of numbers. Firstly, wanted to check, on our current utilization level across our plants. How are we placed in the month of April, May? How are we doing?
We have many manufacturing locations, and I would say that they're all the way from 10% at the low end to 50% at the high end.
Okay, but segment-wise, broadly, can you highlight cycles, engineering, metal?
I don't think we get into that level of segmental data. Traditionally, we've not wanted to kind of share capacity utilization to that level because, broadly to give you a sense, it'll be higher in cycles and lower on on the engineering and the metals businesses.
Sure. So I have, a follow-up.
Hello? Hello?
So it seems this line got disconnected. By the time he joins back, we'll take the next question from Sachin Shah from MP Investment Managers.
Yeah, good morning, sir. And thank you very much for the opportunity and really hearty congratulations for a great set of numbers. In the environment where we see where the top line is going to be under pressure, just wanted to get some sense in terms of our fixed cost and variable cost. Basically, what I'm saying is that if I exclude our material cost, our total cost is about 30% of sales, or in absolute numbers is about rupees 1,200 crores per annum for FY20. Some ballpark range of how much of that would be fixed cost and how much of that would be variable or semi-variable cost?
I always am wary about this fixed cost, variable cost definitions because it depends on what you treat as fixed and what you treat as variable, right? But broadly, I don't think we get into too much more, I'd rather not give too much more cost data than you broadly see from the numbers, right? And I think you can kind of figure it out when you look at segmental data to just understand, what are overall corporate fixed costs and kind of other fixed costs available. I don't know. What specific guidance because what we see, and we've looked at it as well, right? If we just take manpower as fixed, what you see is the cost you incur per month is